Joseph Hogue here with another one of our Sunday live streams, Beer Money Sunday. And even though I'm on coffee today, but grab your favorite beverage, and we'll get started here. Got a really important video to share with you today. One that I think is actually going to save a lot of people out there money because the market just jumped into this new year and was up more than 3% in the first 3 weeks on the back of 13% over the last 3 months. But now it's kind of showing signs of cracking, right? We're getting beyond the initial enthusiasm for more stimulus, and rates are starting to go up. So you need to be watching for clues for what could be the next stock market crash or even a correction. And that's what I'm going to be sharing today. I'm going to be showing you 5 clues, 5 things that you can watch to kind of get you ahead of that, ahead of that correction or ahead of that stock market crash. And, while I'm not calling for a complete stock market breakdown, stock market crash of 20% or more, I don't think that's really going to happen. But there's so many investors out there in the momentum trades, right? And momentum investing it's a popular strategy. It's a great strategy for while it works. But think, shares of NEO, Tesla, anything that's really going up exponentially. All these biotech stocks, the SBACs, right? Any of those. And the problem is that when the stock market does come down, even a 10% correction, which I'm going to share some data with you a little bit later that shows, corrections come even when the economy is booming, even when the stock market, the general trend is higher. You can easily get those stock market corrections of 10%. And the problem is these momentum trades, they're higher beta, right? And that just means they're more volatile than the general market, and they're gonna rise and they're gonna fall more than the general market. So even if we get just a easy correction of 10%, those high beta names, those momentum trades that a lot of people are in right now, those could fall 20 or 30% or more. So it's going to feel like a stock market crash if you're in a lot of those investments. So definitely something you need to watch for, these five clues to watch for that. I see a lot of people coming in on the chat. Thank you for being here. I love doing these every Sunday at 2 p.m. Eastern, just to kind of connect with you on a more personal face-to-face level than we really get in those weekly videos. I want to invite everyone to join the Bowtie Daily. That's the daily market updates that we've got going out. Hugely popular already. Over 6,000 people are already in this, and it's just something I've been wanting to do for you out there in the community for a long time, right? So I've left a link in the chat, a pinned link there. I've also got the link in the comments section and in the description below. Sign up. It's totally free, and it goes out every night at 9 p.m. before the market opens the next day. Kind of gives you the trends, the strategies, and everything you need to be in front of the market for the next day. So I look for the link for that and sign up. It's totally free. I'll never ask you to pay for that. It's just, again, something that I've been wanting to do for a long time for everyone out there. Then, after we talk about those 5 clues, I'm going to get into that Q&A. So if you've got questions, go ahead and hold them till the end, and I'll answer those when we get to those. Now, this part of the video, this part of the live stream, I usually start out by highlighting, some of the last week's videos and upcoming videos. This week, though, I wanted to give a special shout out to really, some of the longest running Bowtie citizens out there. All those of you in the Bowtie Nation. I asked in our private Facebook group for the best stocks that we've recommended on the channel that people have bought into, and the results have been amazing. Really, I mean, you look at some of these. I copied these from our Facebook group. And, so Lifter's Gym, he's up 96% in Macerich. Ant Taylor made $52,000 on our Pinterest recommendation. Pinterest, I think, is up, a few 100%, 200 or 300% since recommending it last year. And he made a killing on that. Amy up 353% in Veritone, recommended that I think back in September. Zscaler was right back then, about a year ago, along with Fastly. Fastly's up about 500% right now. Zscaler's up about 150%. So just some amazing returns from some of the stocks that we've talked about on the channel. And I want to thank all of you on the Facebook group that has been, that's been a part of the community for so long and really engaging with the chat. And that's why I really love bringing that Wall Street level of analysis, that same analysis that I did for venture capital firms and for private wealth management, being able to share that on the channel. And just thank you for being a part of it. If you want a link to that private Facebook group that we have there on Facebook, just sign up for the Daily Bowtie. I've got those links there in the chat and in the description below. Tonight, when that goes out at 9 p.m., our daily market update, I'll leave a link in there to the private Facebook group, so you can grab that link and join up the group there in Facebook. So I want to get to it now, because, like I said, this could be a big, 5 big clues that could kind of get you ahead of the correction or the crash. And again, stocks are undeniably expensive right now. Okay, we're looking at valuations that are 60, 70% above their current or their long-term average. Right? You see the FactSet graph that I show a lot. Great research by FactSet. Love their research. And basically, it's just sector level forward 12-month PE ratios. Okay, so these what this is showing you is these dark blue lines are the current forward price to earnings ratio for each sector. Okay, each sector of the economy, the stocks in that sector, they're trading at this price to earnings ratio, and this is the forward earnings, right? So the earnings that analysts expect all the stocks in that sector to report over the next year, the current price divided by that. So it's kind of a forward-looking valuation tool for the stock market. And then this, the lighter blue lines and the green lines are just longer-term averages for that ratio. Okay, the blue is the 5-year average, and the 10 is a little bit longer-term 10-year average of that ratio. And you can see that every one of the sectors, all 11 sectors of the economy, are trading well above that long-term average. But some of them are just a little ridiculous. You've got consumer discretionary stocks trading at 37 times on that forward PE basis versus 19 times on the on the long-term average. So that's almost 100%. 37, that's 17. So yeah, almost 100% higher than that long-term average. Information technology trading at 27 times that forward PE basis versus a 16 times long-term average. So again, almost double. So a lot of these are trading almost double what they are, on that longer term. Very expensive. You can also look at another chart that I like to use here. This is the for the market as a whole. So the forward PE ratio for the market as a whole, the S&P 500, and then the green line is the 5-year average. The blue line is the 10-year average. And I wish this one went out further, because what you'll see is, okay, so this dark blue, this jagged line here, is that PE ratio for the market. Okay, now sitting at right about 22 times. Investors are paying 22 times, the price times the expected earnings of the market over the next year. Okay, and if this went out further, you would see that that's the highest it's been since 2001, since the tech bubble burst, basically. Okay, stocks are as high now as they have ever been in the past 20 years. But the thing is, stocks don't fall on valuation alone. Okay, stocks can just keep on getting more expensive until it gets a catalyst to bring that crash or even that correction. Okay, the promise of this new stimulus, this $1.9 trillion package that's making its way through Washington right now. Hopes for a second half economic recovery after the vaccines are distributed. That's all propelling stock prices higher. So it doesn't necessarily mean that just because stocks are higher than or more expensive than they have in the past, that they're going to go down immediately. That you've got to have some kind of a catalyst. But corrections do happen, even in bull markets. And even when the economy is rebounding, we're expecting 5% GDP growth in the United States this year. I think it's about 6%, 6.5% worldwide. So, and that's huge. We've averaged here in the U.S., we've averaged maybe 2 to 3% GDP growth a year over the last decade. So 5% is a huge rebound. And stocks don't generally crash during that kind of environment, but they do correct. Okay, the actual average is 2 out of every 3 years since 1966. You have a correction of 10% or more. Okay, so that's 10 to 20% drop in stock prices from the peak, and you need to be watching the signs for that, because again, if you're in any of these momentum stocks, these very fast growing biotech, EV stocks, any of those stocks that have just gone exponential, those could fall 20, 30, 40% very easily, even in a stock market crash, just because they're more volatile than the general market. You're going to have a lot of people, they're going to start losing money in those, and they're going to abandon those trades. They're going to abandon those stocks, and it's just going to exacerbate it. It's going to send them down even further. So, while I'm not thinking that a huge stock market crash is going to happen, because you do have all this stimulus money and these low interest rates supporting stocks, then that market correction is likely. Okay, with stocks at this point, and what we've seen over the past week or two is that the stock market is trying very hard to go higher. It just can't do it. It's kind of reached that plateau where it needs it needs a reason. It needs a real reason to go higher, and it doesn't take much to send it lower. And we're going to go in those 5 clues. We're going to look at some of the reasons why it's been going a little bit lower, or at least volatile around that break-even point over the last couple of weeks. So, but when all this is said and done, I think you can use this to your advantage, because if you do get out or hedge your bets, at least in front of a correction, we get that 10 to 15% correction, then I think you can use that as an opportunity to buy back in at those lower prices, because we do have that longer term support in the stimulus, in the interest rates, and I think you're going to be able to pick up some of those stocks that you like and that you're already in, pick those up at cheaper prices, and be able to make even more money on those. So I want to talk about those clues, kind of some of the things that we're watching. And again, these are the kind of things that we look at every day in that daily bow tie in the market updates. So go ahead and sign up for that, and you'll get kind of a running daily update on all these things that we're watching in the market and as they develop. So now one of the things I want you to watch here is Bitcoin, and these first two are going to be kind of the classic momentum trades in the market right now. Okay, so Bitcoin obviously has had a great year. Went from something like down into like 5,000-6,000 per coin up to 42,000 at its peak a couple of weeks ago. It actually fell 26% from the peak and broke 30,000 on Thursday, right? It's since clawed back a little bit above that. I think it's around 32,500. But the reason why I want you to follow this, even if you're not interested in trading Bitcoin, or whether you are or not, I want you to follow the price, because like I said, a lot of these momentum trades are a real sentiment index for the market. Okay. And let me explain that. Retail investors, a lot of the people plowing all their stimulus money, all those stimulus checks into the market, a lot of the people that they're not going out, they're not spending their money, right? The savings rate is up to like 13, 14%, which is multi-decades high. People aren't spending their money, so they're putting it into stocks, right? And since they don't have a ton of time to watch the market, to analyze the market, they're just putting it into what's going up. Okay, all that money is going into those momentum trades, what's going up. And for the last year, it's been Bitcoin. Okay, and that's why you've gotten that 3 or 4-fold increase in the price of Bitcoin. Well, what happens though is, when people start losing faith in the market, when people start, eventually when people start actually going out and spending some of their money, that could be a big catalyst for all of this, is people not pushing their money into the market anymore, but actually going out and spending it. When that savings rate comes down, that could be a big catalyst for the correction, or even worse, in the market. But anyway, you watch the price of Bitcoin. And, if it comes down more, if it does go back into that 30,000, so to kind of confirm that downward direction in the price, I think a lot of investors are going to look at it and say, okay, you know what? I remember back in 2018 when it hit 19,000, and that was, an all-time high. People were made millionaires by that. But then it came down about 80% in that correction. It came down to, at the lowest was around 4,000. So about 80% sell-off on that. So people are going to be thinking back on that if it does confirm this breakdown below 30,000, and they're going to start getting out. So I think that's really going to hit sentiment for some of these. And it's going to, I think it's going to note a little bit of weakness in the market. The next one that I want you to watch, and this is the other one of our kind of momentum ideas, momentum trades, is ARK, the ARK Innovation Fund, ETF. Great fund managed by Kathy Woods. They're over at ARK Invest. They've actually got about 5 or 6 funds there, and they've done amazing. I think the ARK Innovation Fund is up 180% over the last year. And it's holding a lot of these stocks, the Tesla, NEO, Teladoc, Shopify. And it's not necessarily the ARK Innovation Fund that you're looking at, but just this group of momentum stocks, this group of hot stocks that have all risen, sevenfold over the last year. So what you're looking at, again, just like with that Bitcoin, is kind of a market sentiment index. Okay, you're watching some of these if they break down. So like, for example, the ARK Innovation Fund I think it lost about 2.5% last week, even as the market closed higher. S&P 500 closed 2% higher last week, but the ARK Innovation Fund lost 2%. And it's really, an index, a sentiment index in those hottest stocks. Right, I think it peaked out at $150, $149 last week and closed down to about $144 at the end of, I think that was in the end of Friday. So, as you start seeing these momentum investments, these momentum trades break down, then you're going to see that sentiment shift on the market, okay, especially with the retail investors, but also with, some of the professional investors that follow that momentum strategy. If that momentum strategy stops working, and again, when that stops working, it stops working fast, okay? You could lose 5-10% on your momentum themes really fast. And the problem here is that there's so much money following that theme, following that investing strategy, is when that comes out, then it removes a big buy side out of the market. Okay, when that's billions, tens of billions of dollars, even more, that is following that momentum strategy and following these stocks right now. When that comes out of the market and when these momentum stocks stop paying off like they have been, when they stop doubling over every month or something, people are going to get a little bit hesitant about the market. They're going to get a little gun shy, and that FOMO works the other way, right? That fear of missing out works the other way, where people say, okay, you know what, this fund is already down 4%, or this individual stock is already down 5%. I don't want to miss out on more losses or more. I don't want to lose more of my money. So they're going to sell out of that to take their profits, and that's just it's gonna take that block right out of the Jenga of the market, and it could cause a bigger sell-off. So that's the first two clues, right? You want to follow things like Bitcoin. You want to follow funds like the ARK Innovation Fund. You want to follow some of these individual stocks that are the biggest momentum trades right now. Now these next couple, I want to highlight. You're going to follow. It's going to be a little bit more of the economic data, right? And one of the biggest ones right now is the interest rates, and specifically the 10-year interest rate, right? This is kind of the market, the risk-free rate for the market, right? And why this is important is the fear of this slowing economy really forced the Fed to lower rates to zero. Okay, so these short-term rates, you've got the 1 month rate here is 0.08%. It's basically nothing. Okay, and even the 10-year and the 30-year is very close to zero, to one. These are all-time historically low rates on the long end of the curve. And what the market really does, it watches the 10-year rate. Okay, and what you'll see is, as that reflation trade, they call it the reflation trade, right? Because it's built on inflation, it's built on the rising economy. As calls in the market came for more inflation later on towards the year, you just can't push $7 trillion into the economy, have nobody spending it, and think that you're not going to get inflation. Okay. All that government money, the stimulus, the money from the Federal Reserve pumped into the economy, you're going to get higher inflation, okay? That combined with just generally rebounding economy, 5% economic growth expected this year, you're going to get higher interest rates, okay? And you see just since the 4th of January, okay, so just in the last about 2.5 weeks, the 10-year interest rate has risen from 0.93%, so a little under 1%, to 1.2%, and actually it was up to 1.15%. Okay, so that's that's 25 basis points, 0.25% within 2 weeks there, which is huge at that level. That's about a 25% increase in interest rates just over 2 weeks. And that's really when we saw a lot of the sell-off and a lot of the market volatility happen just about a week ago. It's since come down a little bit. It came down to 1.11%, and it's edged up here on Friday, which is why we had another sell-off on Friday. But what you want to do is you want to watch this and really right around the anytime when the CPI, that's the consumer price index, or the PPI, the producer prices, anytime those are released by the government, that's going to be kind of a catalyst for this inflation, for these inflation worries and higher interest rates. Okay, these higher interest rates, they're gonna kind of creep up as we go along and get more economic data anyway. But you really want to watch them around those inflation and consumer prices and producer prices releases, because that's when it could spike. And there's a couple of reasons why this is so important right now. One is that you get higher interest rates, and that makes bonds more attractive, right? It makes safer investments more attractive because if we get up to 1.5%, then you can earn 1.5% in a treasury bond, a risk-free, no-risk treasury bond. You get 1.5% off of that. Versus some stocks or some of the safety sectors, utilities get hurt a lot when interest rates rise. Real estate stocks get hit when interest rates rise because they're just not as attractive. Okay, these yielding assets aren't as attractive when you can get risk-free rates of return from treasuries. So that's one reason. Another reason why, especially people are talking about rising interest rates and the tech stocks is because it's kind of a valuation thing as well. The valuation, basically everyone knows the PE ratio, right? The price of the market or the price of a stock divided by its earnings. Well, you can flip that on its head in what's called the earnings yield. Okay, so the earnings of the market or of a stock divided by its price. That's how much earnings you get for that price, an earnings yield. That's a yield on your price, okay? Well, a lot of people kind of use that as a valuation comparison between bonds and stocks, okay? So, with the 10-year interest rate down below 1%, 0.93% at the beginning of the year, and then you look at even fairly expensive tech stocks, which are trading at, like 40 times 40 times earnings, right? Hugely expensive price to earnings ratio. You flip that on its head, it's about a 2.5% earnings yield. Okay, so if you take an index or a sector like the XLK, the Spider Technology ETF, if you take all the earnings from the stocks in that sector, in the tech sector, and then you divide it by the price of that fund, then you get about a 2.5% yield. Okay, well, 2.5% is not great, but it's still a hell of a lot higher than the 0.93% you're making on the 10-year bond. Well, what happens though is when those interest rates move higher. Now the interest rates are 1.12, 1.15. End of the year they could be up around 1.5%. That spread on that earnings yield doesn't look so attractive anymore, right? Because remember, you're getting that 1.5% on bonds. That's risk free. I don't know what you think about the current U.S. government default possibility or how much debt they're issuing, but it's pretty much risk free. They're not gonna default on their debt on the treasury bonds because they can just print more money and pay for it that way anyway. So that's risk free, and you're making that 1.5% risk free. Whereas, you're taking a pretty big bet on tech stocks right now, and you're still only getting, maybe 1% extra earnings yield on that. So, as interest rates rise, then the reasoning behind especially a lot of these very expensive sectors, especially tech sector, the techs, consumer communication services, which includes all of your FANGs, your Facebook, your Google, all the internet services, internet providers, that kind of thing. Those are all incredibly expensive right now, and so that means the earnings yield is very low. So if you're looking at an earnings yield of 2-3% on those, why take that much risk if you can get just as good of a return or close to it in a risk-free bond? So that's kind of the reason why interest rates are talked so much about in the markets right now, and the fear that as interest rates rise, then that's going to take less of that impetus out of stocks. Okay, so that's one thing you want to worry about. The next one here is the housing market. Okay, and a lot of people haven't really been talking about the housing market in this way, but I think it's more important than you might think. It's really, the housing market's been one of the lone bright spots in the economy all through last year. Okay, housing prices are up something like 15% year over year, which is absolutely ridiculous. You look at long-term price appreciation on residential real estate, it's more like 3 to 5% at the most, right? And yet it's jumped 15% over this last year, and it's because people aren't selling their houses, really. There's just so little inventory to sell. But besides the fact that prices have been going up and supporting that, refinancing is just exploding, and this is really a source of cash for the market right now. Mortgage applications are reported every week, and they have a refinance component. And what we're seeing is so many people are taking money out of their house. This is really a repeat of what we saw in 2004 through 2007, 2008. Okay, the housing market is going up so much. Housing prices are increasing so fast that people are refinancing their houses, taking out tens of thousands of dollars in cash in there. And where are they putting it? Again, they're not spending it, so they're just putting it back in the market. They're using their house as a funding source for their investments. And it's worked, it's worked great over the last couple of years. Stocks have been going up and all that kind of thing. But what happens, and we saw, like I said, we saw this in 2008 when the housing market crashed, and not only did now people owe more than their house was worth, but it's just that source of cash that comes out of the market. Okay, when interest rates do start to rise, people are going to be left without that source of cash. Okay, if rates go back up to, on the 30-year, if rates go back up to 2.5%, that refinancing isn't going to look as smart anymore. You're not going to save as much money, and people are going to stop doing it. So, as these interest rates increase, you might see kind of a big spike in refinances real quick to get in on that. People are going to be worried that rates are going to keep going up and they're going to be priced out, and they're not going to be able to refinance their house. So you're going to get a big spike in refinancing, but then it's going to be nothing. Okay, then refinancing and the mortgage market is just going to collapse, and not only is that going to hit the housing market, which you'll see prices come down, you'll see investor sentiment come down, but it's just that cash that has been plowed into the market through those refinancings that's going to dry up. So that's another catalyst that could watch. And so again, mortgage applications are released every week. They have a refinance component. So you want to just watch that, when that data comes out, and kind of watch the trend on mortgage application, because if we do get that big spike in mortgage applications, people scared, that fear of missing out, that interest rates are going to keep on going up and they're going to miss out on being able to refinance. So you're going to have that big spike, and then watch for it just to kind of collapse after that, because I think that's going to be a big warning sign. This fifth clue here that you want to watch is just generally earnings, right? And not necessarily the level of earnings. Okay, so we've got fourth quarter earnings so far, and they've been really good. So far, 90% of the companies that have reported their fourth quarter earnings have beaten expectations, which is actually over the average. The long-term average is about 80%. Companies almost always beat their earnings estimates for that quarter, right? They through the quarter they kind of say, we might not make quite as much, or the economy isn't that great. Analysts downgrade their estimates for that quarter, and it's basically just kind of a game, right? Companies love to be able to beat their earnings expectations, and the market's expectations for those earnings, just to be able to say, look at what a great job we're doing. The millions of dollars you're paying me as CEO is worth it, because look at we always beat those expectations, right? It's just kind of a game, but it is important to look at that level. But the real clue here is the market reaction to those. Okay, so does the market punish the stocks for only slightly beating those expectations? Is it demanding a large beat? And this is really what we've seen over the last couple of weeks with bank stocks, and to a smaller extent, some of the energy stocks. Okay, we saw bank stocks up maybe like 24% over the last 3 months, and now they're down 3% over the last 5 days, and it's because these banks, JP Morgan was out, Wells Fargo was out, Citigroup is out. A lot of these banks came through. They beat their earnings expectations. They made more money than the market was. They made more money than the market was expecting, but the market's still punishing them. They're punishing those stocks because the prices just got a little bit ahead. The market was wanted them to beat by an even larger margin. And it's just a sign of an overextended market. Okay, it's just The market is getting ahead of itself. Just beating those earnings expectations are no longer good enough. You have to have a huge beat. Okay, so you need to be watching that. As the market punishing stocks, not just for missing their expectations, which, yeah, if a company misses how much earnings people thought it was going to make, then yeah, the stock price should drop. But is it punishing them even when they slightly beat those expectations? That's a sign of an overextended market. Going to get a lot of earnings reports this week, so it's going to be something that you want to watch this week. I think it's something like 100 stocks, 100 companies in the S&P 500. So about 20% of the index, 20% of the market is going to report their fourth quarter earnings this week. So it could be a very volatile week if the market decides that it wants to punish stocks for not beating on a wider margin. Okay, and it's going to be a lot of the tech stocks are going to be reporting this week. So make sure you watch for that.